let's talk about a story from 2025, a real puzzle that tripped up a lot of new investors. You had a company right at the heart of the AI boom, but its stock just stumbled while others were taking off. Today, we're going to solve that puzzle and pull out some seriously powerful lessons that you can use to navigate the market. Okay, so let's just dive right in with this question. We've all heard that old saying, a rising tide lifts all boats. But is that really true? Especially in a massive tech boom? Well, the story of Supermicro back in 2025 tells us the answer is way more complicated and, honestly, way more interesting than you'd think. So, here's how we're going to break it all down. First, we'll set the scene with the AI server boom. Then, we'll get into the weird situation with Supermicro. After that, we'll uncover the hidden pressures they were dealing with, see what the real winners were doing differently, and then, this is the important part, we'll wrap it all up with clear lessons for your own investing journey. To really get this story, you have to rewind to 2025. The entire year was just defined by this insane, insatiable hunger for AI infrastructure. It was like a modern-day gold rush, and everyone was looking at the companies making the picks and shovels. It was an absolute arms race. I mean, you had tiny startups with a revolutionary AI idea fighting against massive tech giants for the exact same, very limited supply of servers. This crazy competition for computing power created what looked like a golden opportunity for anyone making the hardware. And right in the middle of this chaos was a company that seemed perfectly positioned to just ride this massive wave. The company was Supermicro, and on paper, they looked like they were going to be one of the biggest winners of the whole AI revolution. You see, Supermicro's business was pretty straightforward and absolutely essential. They were building the very machines, the servers, that power AI. In a market that was screaming for more computing power, they were the ones selling the shovels during a gold rush. I mean, it sounds like a foolproof plan, right? But this is where the story gets really weird. Take a look at this chart. It shows a huge disconnect. While the rest of the tech world, the NASDAQ, was flying high on all the AI hype, Supermicro stock was actually falling hard. Think about that. Record demand for their stuff, but their stock was in a nosedive. How is that even possible? This right here is the central mystery we're going to solve. And we're not just going to guess. We're going to be detectives here, digging into the actual verified data from 2025, the market reports, the company filings, the analyst calls, to get to the real story. So the answer wasn't in the big, flashy sales numbers. I mean, revenue looked great. The real story was hiding just beneath the surface, in these invisible pressures that were quietly squeezing the business. And this brings us to a super important idea called margin compression. Let me break it down for you. Imagine you own a coffee shop, and you're selling more lattes than ever. Your revenue is through the roof. But what if the price of your coffee beans and milk has tripled? You could actually be making less profit on every single cup you sell. That, in a nutshell, is margin compression. And that is exactly what the data showed was happening to Supermicro. They got caught in a perfect storm. Their profit margins were getting squeezed, they were having issues managing their inventory, and a whole flood of new competitors jumped into the server assembly game, which started driving down prices. Okay, so if Supermicro, the server assembler, was struggling, who was actually winning in this AI gold rush? Well, to figure that out, we have to look at the companies that built their business on something a lot more solid. And wow, this table just lays it out crystal clear. You have Supermicro, the assembler, basically putting together parts from other companies. But then you have the real winners, innovators like NVIDIA, who owned the core can't get it anywhere else technology, the GPUs. And you have the essential infrastructure players like Vertiv, solving a critical problem like cooling that you just can't skip. The lesson here? It really, really pays to be indispensable. So this is the most important part. What can we all learn from this whole story? How can we take the lessons of 2025 and become smarter, more patient investors as we head into 2026 and beyond? Okay, here are 4 timeless rules that this case study teaches us. 1, you have to look past the revenue hype. Profit margins, that's what tells you the real health of a business. 2, really analyze the business model. Ask yourself, is this company just an assembler taking whatever price they can get, or are they a true innovator that can set their own prices? 3, and this is a big one, don't put all your eggs in one basket. Diversification is your best friend. And 4, follow the real data. You have to patiently use the free tools out there, read the company filings, that's where you find out about the real contracts, you can spot those margin trends, and see trouble way before it ever makes the headline. If you walk away from this with just one thought, let it be this one. Don't get blinded by soaring revenue. A company that sells more and more stuff but makes less and less money on each sale, well, that's a company heading for trouble. It's such a simple but powerful lesson. So, as you look out at the market today, at all the hot stocks everyone is talking about, remember the story of Supermicro. I'll leave you with this to think about. Always look past the hype, dig into the numbers, and ask yourself, is this a real innovator with real power, or is it just another assembler riding a temporary wave? The answer to that question could be the difference between a really smart investment and a really costly mistake.